Europe does not build technology, it regulates it. Politicians in Brussels pride themselves on writing the rules for the digital world. They call it a global success. The data proves it is an economic suicide note. 20 years ago, European corporations made up 40% of the world's 100 largest companies by market capitalization. Today, that share is down to 15%, while the United States deployed $924 billion in venture capital over a decade. The entire European Union managed just $130 billion. Europe systematically starves its own innovators and taxes growth before it even happens. You are told this bureaucracy protects your rights. In reality, it guarantees your stagnation. Today, we analyze the exact mathematics of how Europe regulated itself out of the global tech race.
The primary tax on European innovation is not financial, it is administrative. The European Union treats compliance as a product, forcing startups to allocate capital to lawyers instead of engineers. Look at the empirical evidence. A study published by the National Bureau of Economic Research demonstrated that the introduction of GDPR led to an immediate 13% reduction in venture capital investment in the EU by US investors. It created a permanent funding penalty for young technology firms. According to recent industrial data from 2026, regulatory compliance costs have ballooned to approximately 500 billion euros per year across the EU economy. Now, Brussels is compounding this error with the EU AI Act. For a small 5-person tech startup, the legal overhead to clear high-risk AI classification acts as an entry barrier. It forces entrepreneurs to choose between expensive legal audits or shutting down their product. The result is predictable. Capital flies to jurisdictions where builders can iterate without waiting for state approval.
Defenders of the European model point to early-stage funding. They claim public institutions like the European Investment Fund cover the gap. They are wrong. Europe is efficient at funding ideas, but it is incompetent at scaling companies.
Official registries from Dealroom and PitchBook reveal that European venture investment in mature growth stages is over 80% lower than in the United States. European institutional investors, including pension funds and insurance firms, hold a miserable 1.45% of their capital in private equity. This suballocation starves companies when they reach Series B and Series C rounds. A European startup can easily secure 1 million euros to exist, but it will fail to secure 50 million euros to dominate. To survive, the company must cross the Atlantic. The capital starvation continues into the public markets. In 2025, Europe's fragmented stock exchanges accounted for a mere 8% of global initial public offerings. Wall Street has monopolized market liquidity. This structural divergence forces Europe's greatest technological achievements to abandon their home countries. Consider Sweden's Spotify or the United Kingdom's chip designer, ARM. Both were built on European talent, yet both bypassed local exchanges to list on the NASDAQ. Data from capital market reports shows that tech firms listed in the United States command significantly higher price-to-earnings multiples compared to the same assets in Europe. Listing in London or Frankfurt means accepting a structural discount. European regulation creates the restrictions, and American capital reaps the profits.
The defenders of the Brussels regime argue that regulations contain protections for small enterprises. This is a mathematical fiction. Look at the compliance framework for the EU AI Act. Data from technology infrastructure audits shows that a high-risk AI assessment for a small 5 persons demands heavy legal overhead. This isn't a tax on profits, it is a tax on existence. You are forced to deploy capital to verify compliance before your software generates a single euro in revenue. American startups launch products in weeks. European startups spend months filling out state questionnaires. By the time a company obtains authorization, its American competitor has already captured the market.
To cover this self-inflicted paralysis, the European Commission offers a solution: state subsidies. The Draghi report states that Europe requires 800 billion euros in additional annual investment to remain competitive. But state committees cannot replace free capital markets. Public funds in Europe are distributed based on political criteria and administrative metrics. They reward companies that excel at writing grant applications, not companies that build superior products. While the United States allows capital to find efficiency through market risk, Europe forces innovation to beg for political permission.
This technological paralysis is not an accident. It follows the exact structural flaw we observed in European labor laws and the insolvency of state pensions. The European model is engineered to mitigate risk, and it has successfully mitigated. Choice is binary. You can build rules, or you can build the future. You cannot do both. Capital has already made its choice, and it is leaving the continent. To understand how this administrative friction destroys wealth in other sectors, watch our analysis on the collapse of public pensions. The links are on your screen. If you want to understand the machine behind global wealth, subscribe to Prosperity Engineering. Until next time.